All right, so now we are going to begin the lecture in earnest, right? We're going to really start talking about financial accounting. So some of you may be wondering, why is this material important for me? Why is it important for me to understand accounting? I might be planning to have a career in consulting or project management or marketing or product management, project management, supply chain, human resources, finance. There's all kinds of different careers that you could be choosing as a College of Business major. So why am I looking at an accounting textbook? Why am I sitting in an accounting class? Well, the short answer to that is that all of those careers that I just listed off need to be able to understand the stories that accounting tells. And that's really the way I like to kind of describe accounting to the introductory classes. Accounting really is the story we tell about how our business has operated over the past year, the past quarter, however long the time period has been that we have decided to report on. So it's really, really important for you. It's really important for the future of the company that you're working for. You know, it's important for investors, creditors, and other external parties to really understand accounting. I've told people for a long time now that if you understand accounting and you are a manager, if you understand accounting and you are a marketing major, or you are a fashion design major, and you understand accounting even at a base level, you have such a foot up on the competition. You have such a foot up on your peers, because accounting really is the language of business, and it's the language that they're going to speak. When you're sitting in meetings, that's the language they're going to speak. So the first objective that we're going to go through is we're going to talk about the two primary functions of financial accounting. And these will go fairly quickly. So like I just said, accounting, it's the language of business. It's what we use to tell the story of how our entity has operated throughout the, we'll just say year. Typically it's going to be a year. So it really is the language of business. And if you can speak that language fluently, you're going to have great opportunities ahead of you. So what we're really using this information for is to inform external parties about our company, about the financial health of our company. So this is going to include people like investors, creditors, customers, suppliers, managers. You can see the list right here. This is not a comprehensive list. There are lots and lots of different external parties called stakeholders that are going to be interested in the financial health of your company. Here we'll stop for just a second. I hope you have your note packet out or open because now we're going to start filling in those blanks that you see on there. Anything that is going to be red and underlined is going to need to be filled in your notes. We've provided these with you kind of pre-prepared to kind of help you follow along with the lectures and the examples that we're going to do. So what is financial accounting? Well, financial accounting is essentially just information that we're providing to external users. We call that financial accounting. The two major functions that we have with financial accounting are to measure and to communicate. Those are the two big things, right? So how is the business activity going to be measured? How is the business activity going to be communicated? Those are the two functions of financial accounting. As we go through the class, you'll understand a little better why this process exists and how the measurements being communicated help people make these better decisions. So a good example would be like investors, right? Investors want to make good decisions related to like buying and selling shares in their company's stock. You know, is the stock going to increase? Is the value of the stock going to decrease? And really, the value of a stock is tied almost directly to a company's ability to make a profit. You'll see later on. We'll look at examples that show you that you know, if a company's net income has increased, typically their share prices have increased, right? You know, creditors, they also need to make decisions on companies based on the financial health of the company. A bank is not going to lend you money or allow you to sign a note if your company is in poor financial health. They're just not going to get paid back, and they've got no interest in not being paid back, right? They're not lending the money to you out of the kindness of their hearts. They are lending the money to you to make money on lending that money. That is something called interest. Interest is the cost of borrowing money. That is how those banks make their money. So we just got a quick illustration right here. This just shows the measurement and the communication cycle that we use, right? So the company starts, they need the activities measured. Accountants are the ones that do the measurement of those activities. They prepare financial statements. They prepare other types of reports. Those reports are then used to communicate information to external interested parties like investors, creditors. The government sometimes is an interested external party for tax purposes. And then those external parties make decisions about the company, and we start the cycle all over. So learning objective 2, we're going to talk about business activities that we use in financial accounting. There's 3 of them, and we're going to talk about what each of those are. So first we have financing activities, and these are transactions that the company is using to kind of finance their operations, right? So these are things like taking out a note or a loan with a bank, issuing stock, borrowing money from others in the form of bonds, things like that. Those are all financing activities, right? And next we've got investing activities. And investing activities are often easily confused with the financing activities. But really what an investing activity is, it's a transaction that involves the purchase and sale of resources that will benefit the company for several years. So if I am a farmer and I own my own farmland, I need a new combine, right? Those combines are not $25,000, $30,000 machines. They are hundreds of thousands of dollars. If I purchase that combine to help improve my land, to help improve the efficiency of my operations, then that is something that is going to benefit me for the course of several years. I have invested back into my company, right? I hope that makes sense. That is an investing activity. When you purchase something like a long-lived or long-term asset that is going to benefit the company for years to come, that is an investing activity. Lastly, we've got the operating activities. And operating activities are just simply transactions that relate to the primary operations of the company. So think of this like if you're McDonald's, what is your purpose? What is your goal? To sell hamburgers, right? So anything that you do that is in the interest of selling that hamburger is going to be an operating activity, right? Because that is tied directly to your operations, your key primary operations. Now, if you are a McDonald's franchisee and you have let's say you have a piece of land behind your store that you own, and you decide to sell it to somebody so they can create a new parking lot or whatever they're going to use the land for. That is not an operating activity because that's not part of your normal primary operations. So we'll get into those little more complicated type transactions later in the class, but just know that if it relates to your primary operation of the company, if you are McDonald's and you are selling hamburgers and that is your primary goal, then it is an operating activity. Next, we'll talk very quickly about types of business organizations, and we are going to kind of just really run through this one fairly quickly because we're really only going to talk about one of these. So the first type we've got is a corporation, and these are entities that are legally separate from their owners, right? There's a separation between the owners and the company. If you've heard anything about tax law in the United States or tax code in the United States, you know that corporations are treated as separate people, right? They really are a person, okay? So you think of this, when you think of a corporation, the owners are separate from the corporation, okay? They have limited liability. So if someone were to sue, let's say the Waltons, right? If they were going to sue Walmart, the Waltons are only on the hook for the cost of their investment in the company, right? Now, that may be significant because it's Walmart, but they're not going to go after their personal assets. They're only going to go after the assets of the corporation. Now, a sole proprietorship is completely different. That is what you will see in most mom and pop shops, what we call mom and pop shops, small businesses in your local area, right? Those are typically owned by one person, and there is no limited liability there. If you own a sledding company and you shove somebody down an icy street on a sled and they break their legs and they want to sue you, and your company does not have enough cash to cover those damages, they can go after your personal assets. Not the greatest example, but just know that sole proprietorships do not have a limited liability. Finally, we have partnerships. Partnerships is something that's owned by 2 or more people. I don't think I'm going to be asking a question about this, but just know that a partnership requires at least 2 people. You cannot have one person own a partnership. It's got to be at least 2 people. And everything's kind of split equally in a partnership, or there will be a determination when the contract is signed for the partnership on what the split is. But in this class, we're going to focus almost exclusively on corporations. We're not going to be concerned about advantages and disadvantages of other types of corporations or other types of organizations. We're simply going to talk about corporations. They are the easiest to provide examples of accrual accounting for.